Corporate pyramids. Few structures in business are as misunderstood or as potent. Within these intricate towers, a family can command vast empires while holding only a fraction of the actual economic risk. The result is governance with leverage, the privilege to guide, but not always the obligation to provide the capital. Consider now the Lopez family, cornerstone of the Philippines' energy sector. Their elaborate holding framework gives them ultimate control of Energy Development Corporation, or EDC, while shouldering just over 10% of its true economic exposure. The rest, invested by pension funds, international firms, and retail shareholders, collectively holds the economic engine, yet often seeds the wheel. This balance of power is now being tested. Indonesia's Barito Renewables has made an unsolicited approach to acquire EDC. Their offer, announced at an equity valuation of roughly $5 billion, brings forward a question that resonates beyond this deal. When a controlling family faces an exceptional offer, whose interests should prevail? Barito's bid is more than a financial transaction. It's a test of stewardship. For the Lopez family, the challenge is clear. Past achievements in building EDC, securing its geothermal dominance, and attracting world-class investors are commendable. But past stewardship cannot shield them from present questions of accountability. Why such scrutiny? Because the controlling family has the unique ability to decide for many, while investing relatively little of its own capital. Underneath the pyramid, global investors like KKR, Macquarie Asset Management, and Singapore's GIC collectively have exposure outweighing the families. Their participation reflects confidence, but also requires transparency and fairness in pivotal decisions. If this offer is refused, investors deserve solid reasoning, not just assurances. Decisions should rest on clear financial analysis. What are the true long-term returns from holding EDC versus selling? What reinvestment plans stand behind the choice? Ambiguity erodes trust, while clarity strengthens it. 3 pitfalls await. First, treating offers superficially, protecting shape over shareholder value. Second, negotiating in secrecy, sidelining public investors. Third, selling but hoarding cash for undefined growth, widening the gap between promised value and real returns. Yet, this moment is also an opportunity. By inviting independent valuation, consulting external stakeholders like KKR and GIC, and publicly stating how proceeds would benefit all investors, the Lopez family can demonstrate that their structure is not a fortress, but a partnership. Control is a privilege, made possible by the trust and capital of others. Barito's offer puts a price on that privilege. Responsive, transparent stewardship can reaffirm the family's legacy and benefit all who have invested along the pyramid. The ultimate test is simple. Will the decision honor the capital that sustains control, or merely protect the summit? In today's markets, the answer must be more than tradition. It must be accountability, delivered with clarity and courage.